So you know what I think the TLDR here is? I could see it so clearly. I'm going to reemphasize. There are multiple games played in the market. Both can be won. When somebody buys a company and then sells it because price is dropping.
I'm a professional investor, so I call myself these days, and I've been an investor for over 20 years. I do not get the short-term game, like to the point that I think it's all just kind of nonsense and like mumbo jumbo.
Start with not one portfolio, but whether it's one account or it doesn't, there's a way to divide your investment portfolio into, I would call, different buckets or cans, like you said.
How would I feel if this doubled in value overnight? How would I feel if this halved in value overnight? And if you're not at peace with, both of those outcomes, then now is your chance to make those changes before the ass falls out of the market. For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Welcome to the Deep Investing Jungle with your hosts, Luke the Badger Hallard and Krzysztof Monkey Piekarski. This week, dealing with panic selling, how to use options during market volatility, selling rather than buying, wisdom for traders applied to wisdom for long-term investors. Maybe you can guess who's who. Plus, I'm going to have a crack at doing a live valuation for Novo Nordisk using our favorite tool, fiscal.ai.
Badge, usually we save our chit chat for last, but you sound a little groggy today. You sound a little, you're deeper in the jungle than usual. You're in like under some shadowy.
Deep in the jingle. Yeah. Went for a bottomless brunch with a couple of very close friends on Saturday. One of whom is like a regular podcast listener. So shout out, hey Mike. And bottomless brunch turned into like a 12-hour drinking session of some very fancy venues in London. It was very good, but like this is the hangover that's like reached across time and is still watching me on Monday.
Oh my God, we ain't spring chickens anymore. Remember when we used to be like 20, 21, 20, you do the things and the next day you're like, let me at them again. Let me at them again. And now we need 2 whole days?
Yeah.
God.
I'm pretty good. I lived in Hong Kong for 6 months and that just made me immune to alcohol. So I do pretty well with hangovers, but but this one hit me.
Hey, do you subscribe to any of the magic hangover cures, like, vitamin stuff or orange juice or whatever other things? Do you do any of that?
No, like you and I, we got a shipment of Magic Mind a couple of years ago when we were working for Seven Investing. Like if there's anyone out there who wants to like give us some freebie like hangover shit, we'll take it and we'll promote it on the show if it's good stuff. But no, I don't take anything like that. I just, try and stay hydrated.
It's very weird. For me, hangovers last until approximately 8 p.m. the next day. Yeah. So I know I just need to make it to 8 p.m., the following day and then the clouds clear. But I'm sorry that you're joining us 2 days afterwards and you're still, anyway.
Self-inflicted.
Yeah. Okay. All right. Last week was a tough week in some ways, because from one perspective, because the volatility was way up. I mean, the market's way up. Then the next day it changed its mind and then plummeted. And then there was another really big red day. And to us old seasoned grizzly veterans, you're like, yeah. You forgot, Mr. Market forgot its meds. But for many people, most people, it could get really, really bad, and some really poor life altering or financial wealth altering decisions are made in these kinds of times of panic.
They are. And I've got a really good practical example of exactly this that played out on my WhatsApp a couple of days ago that I would love to share with Wall Street Wildlife listeners, because I think this is quite instructive in a number of ways.
Badge, before you go on with this example, I do want to make another sort of pitch for what it is we think we do here at Wall Street Wildlife. I think right now you could find on the interwebs a lot of, for lack of a better term, finance bros sharing their spreadsheets, and that's useful and that plays a part. But it's strange to say that I think in so many ways, the most important thing that people either get right or go horribly wrong is with paying attention to themselves and how their own minds work, the psychology, the behavior of all this. We talk about this endlessly. But they think to themselves probably, oh, that's squishy. Oh, that's soft stuff. Oh, you're going to tell me about meditation. You're going to tell me about breathing. You're going to blah, blah, blah. And yet that's precisely the ditch people fall into because it's so fundamental to the whole enterprise. If you can't control yourself, or if you're out of control, your emotions get the better of you, so on and so forth, you are going to make egregiously bad mistakes that no spreadsheet analysis could fix for you. So if you're a beginner listening to our show, or even if you're a seasoned vet, but you still find yourself making behavioral type mistakes, listen hard, because we hope to walk you through some things to watch out for and ways to get better.
Yeah, good. A good intro to that. Because you're right. Like we're still in, like we're recording on the 20th of October today. It's nearly Halloween. We're still in the midst of this like incredible growth run where stocks are very expensive, but seemingly like new all-time highs almost every day. Okay, yeah, like occasionally we get like a bit of a down day, like we did, like last Friday, 10 days ago. But then the market seemingly recovers like the next day. And if you listen to episode 102 last week, we focused on like the dangers of leverage and people who got blown out of the market because they had like too much risk on. But even if you're like a simple investor and you just picked what you feel are good quality companies and you have like a nice diversified portfolio, it can still be scary. You're not going to get blown out of the market because you're not leveraged. But if you see your portfolio go down by, a significant percentage and you're not ready for that, you're not emotionally prepared for that, you might panic. And I've got just a brilliant example of how this played out with a very close personal friend of my wife and I. It's not a real name. I'm going to call her Sarah for the purpose of this because I said I'll keep it anonymous. So Sarah, had a conversation with Sarah. She's been investing in her ISA, so doing it in like a tax efficient way. She and I had a chat maybe a year and a half ago, and she went from like investing in kind of meme stocks and garbage, and she started listening to actually the podcast and getting into it and the discipline and understanding what it meant to be an investor. And she's built actually a really nice diversified portfolio that actually are quite a nice mix of badger and monkey stocks, actually. She's got a few of her own ideas in there as well, which is brilliant, but she's got a lot of, I think, quality in her portfolio. And just this particular example was IREN, one of yours. Actually, we both own it, but one of your initial ideas. And IREN has gone absolutely bonkers. What's it, like a 4 or 5x the U, I think, something like that, like a 500% return, that ballpark. So Sarah had a chunk of cash in IREN. And this is hilarious, the timing, because we had a conversation on WhatsApp maybe just before like the big down day, a few days prior, like last Thursday, last Wednesday. And she was asking me, like, how do I know if I have too much money in this stock? And then you and I went on to have a conversation, and I posted some stuff on Twitter about it, about, is your position size correct? Have you got too much exposure, not enough exposure? And the good test being the can you sleep at night test. And so Sarah applied this thinking, said, I feel good. And she actually said, I don't feel worried, so all good about her IREN exposure. And then literally like 24 hours later, I get a message from her saying, just as you said, the stocks I have are volatile. They all went down. I sold my IREN shares in a panic yesterday, but happy to have made a good profit. I can buy back in again if they start going up. I know in hindsight, I should have trimmed it. I didn't think I was worried, but when I saw it go down quickly in a day, I just wanted to put a stop on it. Didn't know how to do that. So I just panic sold everything. So she's sort of self-admitting to, what's gone wrong here. Now there are a whole bunch of problems in this thing, but let's just focus on the cool one to start with. And we can maybe explore this in more detail in this conversation. like Sarah thought she had an exposure to IREN that she was comfortable with. And she said she'd asked herself the question, my framework, just put yourself in that mindset. What happens if it doubles tomorrow? What happens if it halves tomorrow? If I feel like I've got the wrong allocation, I'll fix it. And she said, no, I'm good. I feel like I'm not concerned. I feel like it's right. And then it did drop. So she hadn't really done that exercise properly because she said, I'm fine if it drops. And then it dropped and she wasn't fine. She panicked and she sold in a panic. So maybe let's start there, because that's such an easy mistake to make that all investors make at some point or another. And as you said in the intro, it's only when you've seen this play out many times before that you don't panic. Instead, maybe you go and reassess. You try and figure out, why did it go down? But you certainly don't do anything quick to respond.
Yes, I'm searching for the quote that captures this, which is by Sir Mike Tyson. Everybody has a plan until they get punched in the face.
Right.
And, in some ways, I mean, we laugh, but this is a real human thing. I'm going to go off on a little tangent. Forgive me. This is what I do, Badge. This is why you pay me the big bucks. I was, for my Fire Philosophy podcast, I was talking with my co-host, Professor of Religious Studies, Dale Wright, and we were writing about courage. He wrote a 5-part series about courage. We were discussing, well, it's all fine and good to know what courage is, to be able to discern different kinds of it, different levels and so forth, but how do you cultivate it? Like, how do you actually become a more courageous person? I think that's a fundamentally, central question. And most people remain or keep things in the abstract, as we're talking about here. One of the things I said, this will not surprise you, at least on the level of courage that has to do with, let's say, bravery or, running into the fire to save somebody, to put somebody else's well-being ahead of your own. You need to actually practice it. So for me, I do that in the jiu-jitsu world, because you can't fake. You can't pretend somebody's trying to break your arm or break your leg or, choke you. You have to feel, to some extent, somebody literally trying to break your arms and choke you. And then how are you going to respond? And in the jiu-jitsu world, the white belts, on the white belt level, what it means to be a white belt is when that kind of attack comes on you, you immediately panic because it's scary. But the more advanced level practitioners know you're going to panic and know the kinds of stupid things you're going to do. And they're right there waiting to take advantage. Oh, you're going to, pull this way. And then when you do that, you open yourself up and then they grab your arms, they turn you around, and now they're ready to choke you and that kind of thing. Well, I think point being is that what you're demonstrating now to me is so key in exposing, forgive that word, it's not intended to be like harsh on your friend, but exposing the difference between thinking you've made a plan and you having lived through and executed and did, you know what I mean? Like theory versus practice. So the bad news, I suppose, is there's no, I don't know about you. There's no other way but like, living through experience. And this is what you and I have, decades of.
I think you're right. As I think about this, as you speak now, maybe you can practice, but I don't recommend this practice to anybody. But you and I, we've played a ton of poker in our lives. I learned a lot of these skills about mastering my emotions and not panicking. As long as I know I'm making good decisions, not worrying about the result. I learned those skills at the poker table, but it took like decades. And it took, you go and you play your A game, you just be unlucky and like you get a beating, you lose a couple of $1,000 and you're like, wow. But as long as you focus on analyze what you were doing, your decision making, if that was the right decision. Everything else is just luck, just focus on the stuff you can control. So that taught me a lot about building that mental resilience as an investor. I don't recommend that because it's a totally different set of skills, and you don't want to get into the tens of thousands of hours I spent at the poker table. I'm sure could have been better spent in other areas of my life, but that was one way. I don't know how else you practice as an investor other than just being an investor and knowing that in your early years, like, you're going to make mistakes, it's going to hurt. But you're learning lessons that are stealing you for the future, because this isn't a 1, 2, 5 year thing. This is like a lifetime endeavor.
I will admit to you, this is that because my poker playing career was now at least 8 years ago. When I now sit down at a poker table for the pleasure of the game, I could tell that I'm out of poker shape, because not forget the math and forget, being rusty on some of the, analytical stuff, but I could feel my palms getting sweaty because I'm out of shape.
Right.
And there's no other way. I mean, in that world, then, it's different, at the start of the round versus how I feel later in the evening when I've just settled in and, took some bad beats and, whatever happened. But right. So there is that exposure. And also, if I could add, as our resident Zen teacher, mindfulness and meditation has I think a bad, it's not a bad name, but it's been co-opted and corrupted by commercial interests. But in the purest sense, which I feel qualified to speak to, and I would recommend as a practice, can you sit still in the Zen world on a cushion looking at a wall for something like 10 to 15 minutes, still and silent, just looking at a wall? And when I do this with my students in the classroom, I start each classroom doing this between 5 and 10 minutes. I have the peripheral vision to see most students, because they're not practiced. They're shuffling their feet, they're moving their arms. Every itch that comes to mind, they scratch. That is the kind of, call it habitual reactivity, that most humans are prone to. A signal comes to mind and you do something. And the practice of Zen meditation is to literally just be, just sit there, just watch your anxiety, watch your boredom, watch your anger, watch your sense of ease or joy or whatever else might come up with. But if you do that for something like 10 minutes every day, you begin to teach your body what it means to witness panic, but not react from the place of panic. I can't recommend meditative practices more highly, and I don't even care, especially for beginners, if they are doing the kind of more commercialized version of it that is not what I would name as pure Zen or whatever. Just start, just do something like that, and you'll. It's not that you'll see, but I think people would be surprised at how it affects their whole life, not just an investing way.
Yeah. Okay, good. Fair enough. So if you've got any takeaways so far, you can learn a bunch of stuff playing poker, but I do not recommend that. You can learn a bunch of stuff by sitting on cushions and staring at the wall, and Krzysztof does recommend that. But let's make it investing practical. Because
yeah. And you know what? Because we have a Patreon community, I am totally volunteering myself, because I teach this stuff, for anybody who has any questions around anything around these topics to please go into our jungle lounge and say, okay, we listened to your podcast and no, you're serious. This is serious and it has serious repercussions. How do I X, or what about Y? And we'll be happy to talk you through, or, bring another one of your questions to the next pod. But we're not, I'm speaking for myself. I'm not monkeying around when I say this is a profound practice, or these are profound practices that will make a difference for you as an investor.
And so there's a direction we should take the conversation in there as well, because we're building actually a nice community on YouTube. We get a lot of comments every day now on our videos, and it's often like, this stock is up 500%. Like, thanks, that was brilliant. Like, what do I do now? Right. So yeah, I mean, engage with us or find friends, find, buddy, an investing buddy somewhere in your social circle. And you've got someone to kind of lean on when you feel like those dangerous emotions. And, almost as dangerous, maybe even more dangerous than fear and panic is like greed and FOMO, the other side of it. Because that's when you're gonna, like the guys who got blown out of the market because they were over leveraged in crypto, they got greedy. Like they were, fundamentally they were owning potentially a good quality asset in some cases, maybe not in every case, but just the way they approached it with such greed, having like 10x, 50x leverage, that screwed them. That was how they went wrong.
Yeah. And I've fallen into the greed trap plenty of times in the course of 28 years, because we're human. That's the point. I don't know. I don't like the holier than thou aspect. And that's one of the things I think we try to name all the time. I mean, I think of myself as conscientious. I think of myself as a person whose role in the world is to do good. And as a human animal, right? I want more sometimes. I want more for myself and my family and my friends. And then everyone's subject to that. So it's not like anyone's born a saint. Some people are born saints, but most people have to work through this kind of thing.
Right.
Badge, I think this would be a perfect time for me to read a quote from a trader that I am familiar with in the trading community, because I thought it was quite insightful and useful for us as more long-term investors. This person said, "Your inner belief state determines your reaction to uncertainty. Doubt amplifies noise. Conviction collapses it. That's why trading psychology isn't a side discipline, it's the core. You're not trading assets, you're trading your relationship to uncertainty." Now, for the 20th time, there's multiple games that are played at different levels. This guy is talking about the short-term game. So forget the stuff about not trading assets, forget the trading bit. I think this applies as equally to what it means to be a long-term investor.
Yeah.
When you have doubt, meaning I would translate that as when you have not done the due diligence necessary, you will not see that or feel that you're an owner of a company.
Yeah.
You're going to see prices going up and down. And you're probably not going to think in terms of value. You're going to think, oh, I'm losing money. So your inner belief there is, I don't know what I own, and the price is falling, therefore I need to sell because other people are selling.
Exactly right. And like bringing it back to this WhatsApp conversation with Sarah, like she's saying the price is down, I'm panicking, I'm selling, I can buy it back later. Like that, leaning into this quote of yours, like if she truly understood IREN, say in this example, and if she had conviction about it, well, maybe in reaction to the price movement, the right thing to do would be to go and do a bit more research and try and understand why has the price moved. Is it because something has actually just fundamentally gone wrong with IREN overnight? Asteroid hit their HQ, or the business model suddenly broken, huge competitor, like something which has damaged the investment. Because then you might make a structured, like appropriate decision to sell it? Or is it just, which it was in this case, I believe, is it just the whole market's down because like the Republican administration have just tweeted something or they've posted a truth about trade wars with China. It's sent the whole market into turmoil. All stocks are down today. And it just happens that IREN is, down a bit more than most because it's a small cap, highly volatile, highly speculative asset right now. And then there's nothing wrong with the company. It's just what's happening in the wider world. And you might even then decide, well, I'm going to buy a bit more as opposed to panic and selling it. At least you're making like a decision that's grounded in conviction and research and understanding, not an emotional decision.
I think I want to name two badge diagnose what I think is really a fundamental problem in 2025. You're looking at screens, right? People are looking at screens all day, whether on their phone or on a desktop chart. And what is it that they're seeing? They're literally seeing tickers and numbers, right? So that trains your mind to think I'm an owner of an abstract symbol and a price. You've had your lifelong success because you fundamentally bought a company and you think like I am a part owner. In other words, I share in the profits of Intuitive Surgical, which builds robotic arms and helps surgeons. And it took them years and years and years and years of research and building out to actually make these things. And you could see them in the operating rooms, and right. And so the moment the price drops, you would not in the million years think I'm getting rid of all those robotic arms, all those surgeons no longer know what they're doing. You think like an owner,
Right.
Or a house owner, right? You wouldn't just sell your house in 10 minutes because, I don't know, skunk pooped in your yard or, right? You just wouldn't, because you could feel a house, or you live in a house, or you take care of a house. And I guess this rant is a little bit about for people who are prone to the panicking or haven't worked through the panic stuff, is maybe read in 2025 more investor slide presentations where you see the physical things in the real world, right? Or maybe you take like you did, brilliant, Amazon. You went and you took yourself to the factory. I remember that episode, whatever number it was, you came back to talk about your trip to the warehouse with a little shine in your cheeks. You were like, holy smokes, Amazon, like you couldn't believe, right, what it felt like to be inside that factory. And it changed you as an owner of that particular company, did it not?
Yeah, right. Absolutely. Like it's so valuable to be a customer of the companies that you own stock in, and like stepping inside the business. If you get the opportunity, not every company is going to let you have a tour of the facilities, and Amazon do, but you can become a customer of most stuff that you might own in your portfolio. Maybe not like an IREN to bit, unless you're like, buying data center capacity or something, or you're like an energy company. Maybe not like an Intuitive Surgical, because you probably don't want to wish yourself onto the operating theater. But there's a ton of other companies you might own that you can, viscerally own and go, oh, I'm visiting Disney World. I'm a part owner of Disney. Like I just bought my ticket and I'm kind of paying myself.
If I could bring this now back to your friend and IREN. Here's the difference between me and her. No disrespect. I found IREN, back in early 24. So it's been a year and a year and a half that I've been listening to earnings calls, reading the presentations, following people on X, studying Bitcoin and the AI stuff, right? So I don't know. If I were to tally up all those hours, badge, like between, that's in the hundreds of hours now. And so IREN is my, I think, third largest position,
Yep.
both in the jungle portfolio and my urban portfolio. So IREN falls last week. The only thing, like, what did I think to sort of take it to the level of this conversation? I was like, the thesis is that every megawatt hour will be sold because there's this obscene demand supply imbalance between how much electricity we need versus how much is available. Every megawatt hour will be sold, and AI, the thesis says, is just getting started. So this is going to be a thing that runs for 5, 10, 15, 20. I mean, maybe, forever, like the internet is still a thing, right? And IREN, from my understanding, is the company that is the gold standard of what they built, how they built it, and why they built it the way they did. And all of a sudden, the price drops, whatever, 10%, and I'm just going to sell what took 10 years to build and has a future runway of 20 years. Didn't even cross my mind. It was just not one of my options. I'm like a monkey's choices of, okay, how do I do this? Not even on my mind. Segue. You know what I did do?
No.
Actually, this wasn't with IREN, but it's a close cousin. Another one of Monkey's King of the Jungle holdings, Cypher. Same scenario. Data mining center plummets hard. But unlike IREN, I don't have a lot of Cypher. What I did was I sold puts. Badge, do you know, should I explain what that means and why I did that?
I think let's, yes, but then you're now taking us into more complex territory. So why don't we do that after we close out this main bit? Because I've got a couple of things I want to come back to in the Sarah WhatsApp. But yes, you're right. That's a good strategy, but that's like going beyond like beginner strategy. And I think there's still some beginner lessons I want to wring out of this little WhatsApp conversation. Let me just do that to wrap it up then, because I think there's two things remaining that are really interesting. So again, I'm just going to read from the WhatsApp conversation. I sold IREN shares in a panic yesterday, but happy to. I made a good profit. I can buy back in again if they start going up. So like, you know where I want to go with this one, right? It's I can buy back in again if they start going up. And it sounds simple, but it's fatally flawed as an approach, because you're not going to do that. If you've got out of a stock, like say IREN, and you made, maybe you've 4 or 5x your money, turned, a couple of thousand into like tens of thousands, who knows? And then you sold it because you're like, oh, it's going down. I've got to lock in, bank my gains. And it starts going down. Well, you're fooling yourself when you say, I'm going to buy back. Because if it keeps going down, like you'd always be looking for the bottom. You'd be trying to find the bottom and you won't catch it. You won't catch it. So if it keeps going down, you'd be like, oh, I'll just wait, one more day, one more week, one more month. It'll keep going down. And then when you miss the point, because it starts going back up again, because everything just operates in cycles. When it starts going back up again, you'll be like, oh, I missed the bottom. So I'll just wait for it to get back to where it was like 2 days ago when it was really down, and I'll buy it then. But now it's going up and you feel like you've missed the boat. And you're like, I can't buy back in now because I could have bought in for, $10 cheaper a few days ago or last month. And you never get back into this position because you've tried to market time. You failed unless you were incredibly lucky. You failed to time the bottom perfectly. And then you've anchored, like you've fixed your mind on this price that you could have bought the stock at, which you probably never see again. And if you do see that price again, well, it's going down. So you'd be like, oh, I better wait and let it really, really go down. Like you just make life so hard for yourself. And if you, like the simple answer is, I mean, just don't do that. If you, yeah, exactly. Right. Like there's a slightly more advanced approach, which is you might trim a bit. Like last week, I talked about trimming Axon because I think it's incredibly expensive at its current valuation. I haven't got out of it altogether. So there's no price in my mind where I'm anchored to and going, oh, I sold Axon at so many dollars. I'm going to buy it back at so many dollars. It felt expensive. So I just took a little bit off. I reduced my exposure. And that's a way of navigating that. But if you want to keep it really simple, just buy good quality companies and hold them for a long time. Don't mess with them. If you really want to keep it simple, don't even look at your portfolio, like coffee can, some of this stuff for decades and then come back and just kind of see what happened.
2 points, Badge, strategy wise. One, also taxes. Most people have to deal with taxes. So I another thing I found that the very hard way, when you kind of sell in and out, you're costing yourself money.
Yep.
The moment you sell a position, if you have gains, you owe money. So you're literally triggering a outflow of capital versus doing nothing. The second point is on the back of what you just said, Badge. I think this is sound for investors of all levels of experience. Start with not one portfolio, but whether it's one account or it doesn't, there's a way to divide your investment portfolio into, I would call, different buckets or cans, like you said. And as a start, I would do something like 90% is your long-term stuff and 10% is, call it, monkey business. But the 90% one, and of course it's personal to everybody, and that would require different kinds of analysis. But for argument's sake, in the 90% portfolio, once you buy something, you ain't selling unless a thesis that breaks.
Yep.
In the 10% one, because it's only 10%, in theory, it's not, you can give yourself a little bit more, call it the momentum stuff. And I don't want to take us to the field, but what I'm trying to emphasize is proportionally, the 90%, if that continues to just sit there and do nothing, you're going to be way more than fine. And then you could give the smaller one over to your impulses and you could feel like you're doing something. And then you learn whether it's being effective or you're playing a game and you're losing at it and you make adjustments. But even if you completely screw that up, your 90% will still be fine.
Yeah. And if you're like totally new as an investor, like your 90% might just be like some index trackers and, big funds and like market tracking stuff. And maybe your 10% is like, this is the money I'm going to learn my lessons with, where I'm going to make mistakes with, feel the emotions, and then, build my skill set over time.
Yeah.
Yeah. Yeah. I want to add on to your comment about tax because it's a really good one. Like there is a real cost. If you do what Sarah did and, you buy a stock and it goes up and then you sell it and you plan to buy it back, even if you were successful in doing that, there's a cost every time you trade. So Sarah's account is an ISA. So it's like a tax efficient type of trading account in the UK, but like a Roth in the US. So she doesn't have any capital gains, but there's still a true cost to her because there's a bid-ask spread. And if you're using like a really simplified trading platform like Trading 212, which is what I use in the UK for my King of the Jungle portfolio, and it's a good product for smaller accounts. Like they don't even show you the spread. They sort of simplify it. They're just one price. But if you were to go onto there and you were to try and buy a stock and then sell it like a couple of seconds later, if the price hadn't moved, you will lose a little bit of money. like when you simplistically, so you go to the foreign exchange bureau, you want to change like your dollars into euros because you're visiting Paris or something. There's like the buy price and the sell price. Well, stocks have that as well. And the gap is known as the spread. And if you trade too often, you're going to pay the spread a lot of times. And and eventually that could wipe you out. It's a fee. Plus, it's slightly worse for ISAs in the UK. I mean, they're incredible accounts. We should all have one. Like, well done to Sarah for having one, but you have to settle into sterling. So she does actually pay the US dollar to pound exchange rate every time she trades. So like simplistically, my advice to her on the WhatsApp was like, just assume you're losing 1% every time you do a trade. And it might only seem like it's only 1%, but if you sell everything and it's like, say, £10,000 and you buy it back, well, that costs you like £100 twice in those 1%. So like they do add up.
Yeah. So you know what I think the TLDR here is? I could see it so clearly. I'm going to reemphasize. There are multiple games played in the market. Both can be won. When somebody buys a company and then sells it because price is dropping, they are, by virtue of their actions, admitting they're playing the short-term game. In this case, your friend thinks of herself not as a short-term player, however. She thinks of herself as a long-term investor. So she made a categorical error. She basically forgot the game she was playing and broke one of the cardinal rules of the long-term buy and hold game, hopped over to the short-term game where she doesn't have the skill set or the understanding to win that game, and she's basically set herself up for losing. So know the game you're playing and then go from there.
Yeah. And like I'm a professional investor, so I call myself these days, and I've been an investor for over 20 years. I do not get the short-term game, like to the point that I think it's all just kind of nonsense and like mumbo jumbo. And you've kind of convinced me it's not. There is something there. I know that's not my world. I don't understand the kind of metrics that short-term people look at, so I just don't play that game.
Yeah, and that could be as simple as that. And I think one of the values that you and I bring to this show, particularly as it's unfolded over the last, 3 years of recording, is that I've gotten more confident in the skill set required to do the short-term stuff. But when you and I talk, we're always labeling clearly which goggles do we have on. And it's not in the, at least I think I'm not, because I'm a long-term investor, I don't need to disparage either game. I just need to know what it is I think I'm doing.
All right. That was a long conversation about a simple WhatsApp. I think really instructive. And I think probably, I think it's a really useful time right now, October 2025, to be thinking about this. And even if you haven't made those kind of mistakes yourself, like really truly ask yourself those questions about like the bigger stocks in your portfolio. Take your biggest position in like an individual company and just really truly try and like sit on a cushion, face the wall for 20 minutes and just feel, how would I feel if this doubled in value overnight? How would I feel if this halved in value overnight? And if you're not at peace with, both of those outcomes, then now is your chance to make those changes before the ass falls out of the market. I'm not saying the ass is going to fall out of the market anytime soon, but it will one day. One day in the next 10 years, my portfolio will, over a relatively short period of time, say a year, probably halve in value. And it's happened to me before, and it's going to happen to me again. Like, I hope I'm in the game long enough that this happens to me another 10 times, right? Because that's just part of the game, part of the cycle. And if you can internalize that, like those moments can become the most profitable, beneficial moments for you, not the most damaging and impactful. But if you sell when stuff is down, that's how you realize those problems, and that's how you really do yourself damage.
It's unfortunate, Badge, but the stage that we're in, we could see because there's a lot of Patreons joining our community. Our YouTube channel numbers are going up. It's always just so I don't know if tragic is the word quite, but it's so unfortunate that we know ahead of time, for better or worse, that most people, they're joining because things are good and everybody feels smart.
But
We're not complaining. We love having as many people listen to us as possible. Pop quiz. What's going to happen, do you think, to our numbers and our rate of growth when the market dives 15%?
Yeah.
How many subscription cancellations are we going to get?
Well, not just that, like we're going to get a ton. We're also going to get a ton of like flat and people chucking shit at us because they're like, you guys suck. You've cost me a fortune. You told me to buy this stock. It's gone down. Like, yeah, that it's going to happen. That's just the nature of the game. And if you really feel like that and you're listening and you're like, if you're listening to this and it's a year's time, 2026, happen to have picked up this episode, like, I'm sorry, like, so be it, right? That is just the way the whims of the market operates. And no, we didn't tell you to buy anything. We're trying to give you the tools and the skill set so you can make your own decisions.
You know who's going to be exempt from that, though? I think legitimately, I think our Patreons that are paid Patreons, I'm legitimately saying I think they have the highest odds of not jumping ship when things get bad because they've already upfront said we're going to pay you because we take you seriously, and therefore they've listened to these podcasts and we're pounding the drums now about the inevitability of this correction, and at least hopefully the majority of them have taken these warnings seriously, and when things crash they won't cancel the subscription because they'll have thought through a bunch of this stuff. Two, you know how I legitimately think of the difference between a beginner and a experienced investor? And this is a little bit from the options world and the short-term thing. Experienced people, experienced investors, traders take advantage of volatility.
Right.
For both mathematical reasons and for pragmatic reasons. They don't fear it. So I don't want to get too into the weeds of complex option stuff, but one small note is that when things go up and down, the IV in options, the implied volatility number goes up, which means you can make more money if you know what you're doing with that stuff. That's for another show. But there's ways to succeed in the market no matter what's happening is kind of,
because you said, is it worth talking about selling puts? Maybe we should sidebar into that a little bit because that is an alternative response to selling the stock.
Yeah, absolutely. So maybe let's save that for next episode.
Sure.
And I will just preview that by saying, when you open my Robinhood app, when I this weekend, when I was processing a lot of what happened last week, and I opened up my Robinhood app and I looked at the first 10 the 10 lines of what I hold, and the first thing Robinhood shows you is options. The stock stuff is below. I think it was 7 out of 10 things that I did were sold puts. So for those of you getting this episode now, you may wish to, ahead of time, do a little bit of your own digging and research into what is Monkey talking about when he's saying sell and put. What is that? What is a put? And then I'll catch you up next week.
Cool. All right. Good stuff. Should we talk valuations? And I want to do a bit of a live screen share of finchat.ai. I've got something to share before I go there.
Yeah. Are you up for it?
Yeah. I think, yeah. The hangover's will be fading a bit. So here's something I'm working on, but it's sort of nearing completion. And I'm calling this my valuation metrics cheat sheet. And So I said I was trimming some companies last week, Axon and Palantir and CrowdStrike. I've been trimming fairly actively. And then there's some companies like Novo Nordisk I'm adding to. Well, that isn't arbitrary. It's grounded in like a bit of thinking and planning. And I don't want to, I'm not going to try and give you a valuation masterclass in 10 minutes in one podcast episode, but I thought I would start to provide a tool that maybe gives you a starting point. So what this little matrix on screen now is companies go through like levels of maturity from like the tiniest, like just like a PowerPoint, like just like an idea pre-revenue. We've got some pre-revenue companies in our portfolios through to mature behemoths that are paying dividends and eventually like they slip into terminal decline. But typically, the company life cycle, it starts small, then it starts generating revenue, then it really starts investing in itself and it scales up and it goes through like a growth phase. And personally, I find that like the really exciting part of its life cycle to catch company in. And that might last, from being an idea to being a growth company, that might be like a couple of years. And then maybe, the best companies stay in that growth phase for decades sometimes. But eventually, all companies mature. They become old. They get their free bus pass and their grey hair. They start or die. Well, yeah, and it's like mature on the road to death, or maybe you have like an untimely death, right? You step in front of a bus because you did something really dumb and you just blew up your business. Of course, there's lots of ways to destroy shareholder value. But anyway, like the purpose of this matrix is, as you go through these maturity phases, there are typically different kinds of valuation metric you can look at. And if we just try and keep this really simple, like if you're a really young company and you're pre-revenue, like you don't really have any numbers. So the only way you can really value a pre-revenue company is based on its future potential. You can look at like, have they got any patents? You can say, what the quality of the management, maybe they've got like a CEO or founder who's had like success and they've exited companies in the past. Maybe they've just got like a brilliant plan and they're in like the right space at the right time with the right idea. So, but it's all that kind of subjective stuff you use to value a company at the earlier stages. But once you start
subjective narrative, subjective, and not just subjective, if I may, not just like I feel because I have warm and fuzzies, but closer to the way an artist interprets narratives and can make sense of complex dynamics and paint a really convincing picture, if you will, right? Subjective in that way. And by the way, I really, for better or worse, intuitively love this stage of investing. That's what I'm good at. It's what interests me. It's what I've developed an intuition for. ASTS being currently, for like a great example of this category.
Agree. And like, with you're taking very high risk when you invest at that stage of the life cycle, but you also have correspondingly very high return if the business is successful. Because not every business that's pre-revenue is going to become a success. Like most will fail. That's kind of the venture capital game. You have to make like 10 plus bets and you're doing well if like one or two of those actually deliver some sort of shareholder return at the end of a fairly long journey. And I would say, actually, I like your comment about it's subjective and the art. I do think actually the art of investing and valuing a company exists all the way along these maturity scales. Like there's still a lot of art to valuing a mature dividend payer, a company that's like, it's now not at the end of its life, but now it's in a mode where it's focused on returning capital to shareholders with dividends and with buybacks. But there are different metrics for the main purpose of this diagram. There are different metrics you can typically use at each stage. And so what I wanted to share here with my cheat sheet is some of the metrics that you could theoretically use at each stage, depending on the type of the company, because a software technology company is really very different to like a financials or a banking company or like a consumer staples company that's selling like commodity products. And so, and this isn't precise. This is a guideline, but it's intended to give you a starting point. And so I thought I would then now apply this to a particular company just to show like one lens in, and also we can do a bit of fiscal.ai-ing, because you did quite a nice screen share of PayPal last week. I thought I would do the same thing for Novo Nordisk. All right, let's get back into it. So fiscal.ai is Krzysztof and my favorite investing, like metrics, tracking, research, understanding the numbers tool. And when you go to Fiscal AI, it's as simple as literally just like typing in the ticker or the name. And on the very first page, you've got a bunch of really useful headline numbers that tell you about the company. But one thing I'm going to do today is I want to do a bit of charting. So, because I want to look at not just this one company, I want to use my valuation cheat sheet. So actually, let's just think about that quickly. So Novo Nordisk is like big pharma. They manufacture typically like originally diabetes medication, and now like the business is leaning more into Ozempic and Wegovy, like the weight loss drugs, but it's basically pharmaceuticals. And they're selling most of those into the US. Like the US is probably more than half of their market. But they are a mature company that is paying a dividend, currently a dividend yield of 3.2%. So if I was to go back to my valuation metrics cheat sheet, this will probably be in like stage 4 or 5, mature growth, or maybe even mature dividend player. And I would actually probably think about this one as being maybe like an industrials manufacturing kind of company. And so typically the kind of metrics in my cheat sheet that I would try and look at would be PE, price to earnings, and also I'd be looking at dividend yield, and then maybe some other sort of finessing metrics like inventory turnover, and return on assets. But let's just focus on PE, because I think that's if we know nothing, it's a good place to start when we look at a company like this. So we can see the PE, price to earnings, for Novo Nordisk today is 16.1. Let's just quickly explain, like you probably know what PE is. Let's just quickly explain exactly what PE is. So you've got, if I'm going to use sort of simple language here, you've got like the value of the entire company, which is based on all the, everything it does and all the money it makes, and it sells stuff and it has to pay for those things. And if you look at we can actually do it in fiscal.ai. If you go to the financials tab, you can look at the 3 financial statements, the income statement, the balance sheet, and the cash flow statement. So every company will have these 3 financial statements. And it's like a story. If you learn to read these numbers, it's a story, and you can see like in the last LTM, that's the last 12 months. So like the rolling year up to today, their revenue. So it's kind of like the sales, how much money they made, which in this case was give or take $312 billion. And then we can see the cost of goods sold. That's like,
actually, Badger, quick note. I wanted to say this before. The units here are in the what's it called? The Danish currency.
Danish kroner, correct? Yeah.
Oh, on the same market cap on the first page, it showed it as 1 point something trillion. In US dollars, it's closer to 185 billion. So maybe click on the USD tab. Yeah,
exactly.
There we go.
Yeah, exactly. No, that's a really good point, because this is actually one of the things I like most about fiscal.ai. It will do this translation from like the currency that the company does its accounting in, which in this case is Danish kroner, but it will translate it to US dollars, because we're about to compare Novo Nordisk to a couple of its peers, which are US companies or British companies. If you look at them all on like a like-for-like basis, like dollars is a fairly standard way to do that. So when we do that, yes, you're right. You can see that their revenue was 48 billion US dollars. And And then the cost of goods sold was $7.6 billion. So that, like, simplistically, if this was a really young company, it's not, that would be an interesting way to measure it, because you'd look at what's called its gross margin. You'd be like, they sold $50 billion worth of stuff, and the raw materials cost them $7 billion. So it's actually a really healthy gross margin. Yeah, like an 84% gross margin. Like, it's like the excess money you generate from when you go from raw materials to the actual thing you sold. And you work your way down the income statement.
Actually, Batch, well, quick point here. You know what I think one of the hardest things to do for every investor is to make the numbers mean something because they're relative. But sometimes it is pretty simple, meaning for somebody completely new to this and you tell them what's a good gross margin, well, I don't know. What is a good gross margin, right? If you think, for example, in the supermarket world, what is that? Like for every item you sell, you only keep 3% profit or something like that, because you can't, supermarkets are ultra competitive and you can't upcharge customers and so forth. But here, Novo keeps about 85%, 85 cents per dollar sold. So even if you don't know, relatively speaking, what's good, what's bad, you can say to yourself, 85 cents out of every dollar. That sounds pretty good, right? Like, something like that.
Yeah, no, you're absolutely right. Yeah. And it's a really important point. Like, you can then, as long as you don't try and compare like a pharmaceutical giant with a supermarket, because they're apples and oranges, they're not the same thing. But you could compare one pharmaceutical giant with another pharmaceutical giant, because fundamentally they're in the same business. And maybe they're even like direct competitors for certain product lines. And so you can usefully compare the gross margin of, say, like an Amazon versus a Mercado Libre, and you can draw some quite useful conclusions about that. No, I don't want to, that was a good sidebar. I don't want to boil to death like the income statement. Maybe we do that in future episodes. I did just want to explain what PE actually means, because as you can see, as you go down the income statement, okay, you got your costs of goods sold, then you get to your gross profit, and then you've got expenses around having a sales team and having like R&D, because you have to develop new drugs. And then you might have like administration, other kinds of expenses. Maybe you've got like CapEx, you have to go and buy like another warehouse or a manufacturing plant. Basically, think of all the things you need to do to run the business, and you start getting towards the bottom of the income statement. And then you might also have to pay like tax, and maybe you earn some interest on some money you have saved. Maybe you have some debt. There's all these sort of financial things that you do when you run a business as well. When it's kind of like you get to the very end, you get to your net income, and that's like truly like your profit. That's like true profit that the company has. It's the income net of everything else. And so the PE ratio is basically, price earnings ratio is basically like the net income, how much real profit at the bottom line of the company generated versus its market cap, like the value of the whole company. And if we go back to that first page, like our quick hint sheet, right now, Novo Nordisk is 16.1 PE. So essentially, if you
well, actually, sorry, that's the next 12 months.
Oh, so yes,
right.
Yes, good point. Yep.
It's 15.
15, correct. Yes, you're right. That's interesting that it's actually, I haven't spotted that it's lower on a trailing versus a next 12 months basis. I'll go and think about that separately.
Yeah.
But
whatever.
Yeah.
Oh, and since I already interrupted you, little side note, when we talk in everyday conversation, we will say things like, what's the bottom line? That's from the income statement. And that phrase, top line, means revenue. Literally what is the first thing you see is how much revenue is coming in.
Right.
Bottom line is, after you take out all the other stuff, what's the essence here? What's the bottom line? Okay.
And let's remind ourselves, right? The bottom line is only that, it's only really useful as a metric for a mature company, because it's already built all of its factories and it's done all its investing, and it's efficient and it's operating, and it's like this smooth, like well-oiled machine. if it was a young company, that just wouldn't be useful because it's still going to spend a ton of money on maybe R&D and break into new markets and do weird things and maybe acquire other companies. When you're like a big behemoth that's like multi-hundreds of billions of dollars, it's unlikely or it's rare that you'll make an acquisition or, change the business fundamentally. But you're much more likely to do that when you're a younger company because you're still kind of finding your feet. So that's why like the PE ratio is really generally, everything here is a generalization, generally most useful to mature, big, established companies. Let's use
And if I may, another one of these sidebars, which I think for many beginners is not obvious. Because not everyone took accounting and not everybody looked at income sheets before. But when you are not making money, in other words, you're still in that, as Badger said earlier, build-up phase, and you look at that bottom line, you will often see numbers in parentheses. And when the number is in parentheses, that means it's a loss.
Uh-huh.
So that means in that year, the company lost that amount of money. And that's why this is maybe setting you up. When a company is losing money, I don't actually know how the algos sometimes compute it, or sometimes they play games with this. So sometimes you'll see price per earnings not available because literally, if you're losing money, you're not earning something. So it's like you can't divide by zero. So they'll show just NA or something. But sometimes it shows a negative number, like negative 340. And that's a little confusing. But the point being is, don't worry about that ratio if in fact it's negative or in parentheses.
All right. So while you were chatting there, I just built live just a very simple chart for Novo Nordisk. And so if you're not on the YouTubes, like get on the YouTubes because that's where we're like starting to show this stuff.
Get off your lazy bum and get on the YouTubes.
But essentially I've pulled some industry comparators. So I did a bit of research on the side just to say, like, who are the main competitors to Novo Nordisk? The really obvious one is Eli Lilly, because they're both competing for the same market around weight loss drugs. But also I just want some like big pharma comparables. So I've also just somewhat arbitrarily pulled in Pfizer and AstraZeneca. So we've got like 4 big names that are broadly like they're doing the same kind of thing. I know they're not exactly the same business, but they're in the same segment. So we can compare them. We can draw some useful ideas. And I've kept this really simple. All I've plotted is market cap, PE, and dividend yield, because these will tell us something about the story. Now, this is not by any means like the whole story to how you do a valuation for a company. There is so much art and there are hundreds of numbers you have to dig into. You have to listen to the earnings calls and read the quarterly reports. But this is like one of the many things you do where you can start to get some piece of the story that you can then like slot into your understanding. So I'm just doing this stuff live, right? So I'm just what I want to do, I want to get to like a nice pretty picture where I can just see in outline, like the story of what's happening to these companies. So here we got them. I've put this as by metric because I've got 3 different metrics. In Fiscal AI, if I said it's a single panel, like it's unreadable, I've got like 3 metrics for 4 companies. So it's like 12 things here. You can't compare them. So I typically like to do it by metric because then I can look at each part of the story at a time. And we've got this in US dollars. So we're going to see like for like rather than local currency. My first part of the story is market cap. So Novo Nordisk is green in this picture. Might be a different color for you, but it's green for me. And if I go here, I can see the market cap of Novo Nordisk today is 260 billion US dollars. And I can see that actually that's pretty much equivalent to AstraZeneca. They're both about the same size company. And Eli Lilly are massive. They're like 3 times bigger. And Pfizer are about half the size. I'm just getting a feel of where they are in the market. But let's look at what's happened. Like actually, the other 3 players have all been relatively stable on a market cap perspective over the last, say the last year to 2 years. But Novo Nordisk has taken a pounding. That's like my green line. And the market cap has more than halved since its peak, which looked like directionally sort of June 2024. It was a $660 billion company. Today it's like a $240 billion company. So it's taken a massive hit. So the first thing we can infer is, like, we have to ask ourselves why, why has the valuation bombed? And that's where you have to start looking at much more information, looking at the narrative. And there were good reasons. They basically screwed up their execution. They had this amazing opportunity with weak UVI, and they made a bit of a mess of it in terms of execution. But, once we know that, we can then ask ourselves, well, what's coming up? And have the company address those issues? Or are they fundamentally thesis breaking issues? And that green line is going to keep going like south until the company's worth like next to nothing and it dissolves. And now we said we'd look at a valuation metric, so PE. So the reason I wanted to screen share this is if you're not on the YouTubes, like, we've got our 4 companies here, and a couple of them, my orange and my purple one, so Pfizer and AstraZeneca, actually had like massive PE spikes or troughs. So it makes it quite hard to see what the hell's going on. So I'm just going to like lock down the time frame and just report. I need things to go a bit tighter. You can see what I'm doing here. I'm just going back to like the last 12 months. And I've literally just like zoomed to the most recent 12 months. So I can get just a feel of like the trajectory of the PE as a simple valuation metric and how Novo Nordisk is stacked up against its 3 peers. And we can see here, actually, like the whole sector has come down a little bit. Maybe AstraZeneca PE has increased a little bit over the last 12 months. But the other 3 guys, we can see here nice and clearly, like, we used to be able to buy Novo Nordisk about a year ago for 28 times earnings. And now we can buy it for 14 times earnings. So notwithstanding everything else, it's like, in some ways, like half the value it used to be. And then because I'm looking at an investment like this in my own portfolio from the perspective of it being an income investment, I want to get a feel of the dividend yield and how that's the trajectory of that over time. So again, these are all actually mature dividend paying companies. And right now I'm getting a 3.2% yield if I own Novo Nordisk, and I'm getting less than that on the other 2. But Pfizer is paying like a massive 7% dividend yield. So you might look at that and go, well, clearly, if you want income, just go buy Pfizer. But you'd need to go and do a lot more work because you might be buying what's known as a dividend trap. Right. So there we are. I've just done a little bit of literally like surface level analysis just to get a feel of what's going on with Novo Nordisk. And the main thing I wanted to share here was not some big conclusion about the company, but just how you use a tool like Fiscal AI to start to get some of these insights. And we could bring in things like gross margin. Well, actually, let's do it. I'm intrigued. Gross profit margin, because we saw that was pretty healthy for Novo Nordisk. I've got no idea how it compares to the other guys. Oh, look at that. Gross profit margin of 84%, which is actually broadly comparable to to Lilly and to AstraZeneca. For some reason, Pfizer, maybe it's a slightly different kind of business model, quite a bit lower profit margin. But that's actually nice to know that Novo Nordisk's profit margin is the highest and also seems to be like sustained highest, whereas the other guys have bounced around a little bit more. So that's actually, I would take that, notwithstanding anything else, I would take that as a fairly good sign.
Thanks for that, Badge. The main comment I have is that I want to say 85% of beginning investors, when they say, I want to buy a company because it's cheap, unfortunately, all they're looking at is the price, which tells you nothing. It literally, I don't know how to emphasize this more than when you see the cost of a stock, it literally does not tell you anything about how cheap or expensive it is. You need the relative comparison between how much a share costs versus how much money they make, at least in this world of mature companies. So, God, what was my point? Oh yeah, the point was that the very first step a beginner needs to take is exactly what you did. You you not only call up the PE, but then you compare it to other PEs. And only then can you begin very roughly saying this is cheap or this is fairly priced or expensive on a rough cursory overview level. At least if you've taken these steps, you're not making a fundamental categorical egregious error of not knowing what you're talking about. So thank you. Yeah, thank you for that. May I now add the next layer?
Yes, please.
The lines you see here are lines I drew when we last talked about Novo Nordisk, which was several weeks ago. Actually, I could count the weeks ago because I could see the lines 1, 2, 3, 4, 5, 6, 7, 8, 12 weeks ago. So 3 months ago, I suppose now, when this was a topic of conversation. Here's the point. What you're looking at on the YouTubes is a weekly chart of Novo Nordisk. I think for long-term investors, weekly is the sweet spot when you're deciding what time frame to look at. That's because it's in between, call it the monthly, very, very high level overview and the daily where you could see more of the gyrations. And the weekly does give you a pretty clear shape, right? You could see the shape of this company's value. So I suppose 3 months ago when I drew that blue arrow down, that was right when we had that big purple drop in price. And on that episode, I basically said, from the momentum perspective, from the trading perspective, you don't want to buy at this moment because the momentum, if you zoom out the 20 weeks from that peak, it is clearly going down. There's the little jags, there's the little jaggedy jags, but if you're buying Novo Nordisk at that point, you are literally buying against the momentum of the market. So that's, I would say, a yellow/red flag. Like you have to, I think the full statement I said is you have to have a very clear reason where you are saying you know more than the market, and you very well might. So what is it that happened after I said I wouldn't buy this here? We saw that for the following, 4 weeks, I was wrong, because then you see the green bars actually kind of going back up. And at one point, see that orange box that I drew? Usually when traders draw on their charts, it's only a line. It's only a single line. And that line is meant to represent where is the bottom, which is called support, and where is the top, which is called resistance. And here, it's a visual thing. It's actually not complicated. All I did was zoom out, and I saw way back years ago, there was this area where the lines were kind of bouncing between. Badge, you could see that, right? From bottom to top, and they were staying within that particular range until I can't actually see the date on this because I'm just using a snapshot I took, until there's the moment where that green line broke out of that orange box and then kept going. And you could see as soon as it broke out, it kept going to the very, very top until the bottom again. So I drew that orange box because I could see, oh, we're back in the orange box again, which to my mind says odds are that we're actually going to be probably stuck in this box again until we either go severely below it or we get one of these green bars above it. And what happened was, interestingly, there's a little tricky thing, is that you could see one of the weeks after I made this chart, that green bar actually closed above, right? That is a danger from the momentum trading spot. That's actually a dangerous moment because you could be, in a sense, given false confidence to say, oh, we broke above that limiting space, and now it looks like Novo is actually going to regain its momentum and start trading up. But you'd be guilty of having itchy fingers because you would technically need to wait one more week to make sure that that's confirmed. And what ended up happening is the following weeks, it actually dropped right back into the box. And now, as of today's day, it's actually that breakout did not happen. And so the momentum still, from my visual perspective, continues to be down/sideways. So were I to want to buy more of this because I believe my own thesis, I would still wait until we got a close on the weekly price above that orange box and basically two closes. And then I would start putting money in.
It's good. And I think we can link this nicely back to where we started today's conversation about know the game you're playing. Because when you have a long-term mindset, you have certain tools, and you have a short-term mindset, you have certain tools, and maybe you're a bit of a hybrid like yourself and you use all the tools. And then you can start to not only like identify and buy great companies, but you can also buy them at a time, like a short-term period. You find the right entry time using some of these indicators, so that you hopefully catch a turnaround.
I mean, honestly, if I knew more about Novo, I would use this time. I guess I would use this moment in the company's history to really get clear about my thesis statement. I would think to myself, I'm not in a rush right now to buy, because the chart is telling me the billions, hundreds of billions of funds trading this thing, they themselves, with all the professional tools they have and all the analysis they have and the inside info they have, blah, 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 nobody is basically winning. There's no argument that these professionals are saying, oh no, this is clearly worth more than whatever the price is saying. So if all those people are kind of stuck in a battle, I, as the little guy, I'm not smarter than them. I'm not going to out hustle them. I would just dig deeper into why do I think this is a good place for my money, and build that conviction. And then once the big guys basically started moving, I'd say, okay, clearly they seeing what I'm seeing. And
yeah, good stuff. Yeah.
Or or I would say I do know more than everybody, and that's possible. But I would just be.
Maybe there's enough on that, because as a long-term investor, even in companies I know really well, I'm not so arrogant as to think I know more than anybody else. But I think maybe I know I'm playing a different game. So I can truly play a long-term game because I don't manage other people's money. I only manage my own. I know my risk tolerance. I know I can suffer a drawdown as long as I feel like it's a good quality investment. And I'm investing in companies. Like I bought Novo Nordisk again last week. I bought that with a view to holding it more than 10 years. And I kind of don't mind. I accept that my investment might go sideways or south for a chunk of time. I just want to get that decision taken and move on, because I've only got so much brain power and I want to be looking at my next opportunity to invest. If you're an institutional player, you can't play that game. You've got other investors' money that you're managing. Maybe it's pension funds, or maybe it's other big firms or clients of your firm. And you're playing you might say you're playing a long-term game, but you're actually not. You're playing a short-term game because you still have to give quarterly reports to your investors. And if you're not in this year's shit hot sector or shit hot stock, you probably feel like you have to buy it, because otherwise if you're underperforming, which most professional investors do, if you're underperforming the market, people will be like, well, why didn't you own Nvidia? You idiots. So so you end up playing a short-term game, even if you kind of delude yourself and tell a story that it's a long-term game. The only people who can be truly long-term investors, I think, are those who manage their own money and really understand the game.
It occurs to me you've made an egregious error in your own investing. I'm sorry to say this publicly to you, but it's what we do. But by allocating more funds to Novo, you did not buy more greasy sausage rolls made by the fine people over at Greg's. So let that weigh heavily on your conscience, Badge.
As I said previously, these are my basket. I've got like my sausage rolls making people unhealthy, and then my big pharma stocks making them healthy again. So
right, you're like Beelzebub. You're whispering diabolical things into people's ears and then profiting off of them.
But these are both well outside of my normal like lane of competence. I know nothing about food retail. I know very little about pharmaceuticals. In Novo's case, I actually really like the story, and I think the numbers do make sense. I have gone through the whole of all three of those like financial statements to understand them in a bit more detail. I think they are in a good place to potentially execute quite a nice turnaround, and they've got a lot of strategic things on their side in terms of the timing of certain FDA approvals and where they are relative to competitors. But I'm not a pharma expert. And in the case of like Greg's sausage rolls, I mean, both of these to me are dividend paying stocks. And so I find dividend stocks, with greatest respect to our friends over at the Dividend Talk podcast, I find them all a bit boring. So like the stuff I really want to do.
No disrespect, gentlemen. Yeah. It's, we're wild animals.
Yeah.
They're seasoned, civilized human beings.
Exactly. Yeah. I get most fun of investing in companies like ASTS and Tesla and Nvidia and companies that I feel are doing really interesting things in the world, not companies that are making sausage rolls. But if that puts a bit of dividend money in my portfolio, well, I need some of that because like I'm a retiree.
Yeah, you need your acorns.
Yeah.
Winter's coming.
Yeah.
All right, Badge. Well, I think that was a solid episode. Thanks for not dying on me mid-air, for suffering through your malaise.
I've got a quick pop quiz for you before we close the episode, because we were talking about one battle after another, and also Tron Ares. I mean, how dare I say those two movies in the same breath? Because in your mind they're incomparable. But have you checked out Tron Ares mode on your Tesla? Yeah.
Can you say that again? What are you talking about? Obviously not. What?
So that if you've got your latest Tesla software, then you have in the toy box, you've got Tron mode, and it is freaking awesome. It's really good.
What in the toy box?
Yeah. It's really good.
Okay, cool. Oh man, I used to have so much. I was one of the first Tesla owners in Austin, and that was the thing that I remember. Like I was showing people, look at all the fun toys in the toy box, right? And of course, it gets old, but I will look into that. Cool.
Yeah, check it out. Leave it turned on for a couple of days, and you'll see the most spectacular thing when you kind of walk away and the car locks. Like, it's awesome.
Okay. Right. Awesome. Badge, are you ready to become a beast of an investor?
I am, and my hangover is gone. Your journey starts.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.